In this short video, I want to look at some practical ways, 3 in fact, to avoid a classic investing trap. We all should be buying low and selling high. Ideally, in practice, it's all too easy to do the exact opposite. No one intends to do that, but there are ways you can fall into the trap of doing so. Okay, so in an ideal world, we'd always buy low, sell high. All right, that would be the right way to make some money in terms of capital gains. We want to be greedy when others are fearful, as Warren Buffett put it, and vice versa. But easier to say than do. So on the right-hand side, what I'm going to suggest is this. Ways to improve your performance, avoid the trap of buying high and selling low, the opposite of what you want to do. Number 1, don't miss the market's best investing days. That can be expensive. Number 2, don't go chasing the latest expensive faddy stocks when they're already priced up. And number 3, whilst passive investing has its place, definitely don't be too passive. Know what you're doing and what you're risking when you take on a passive approach. Okay, so let's take those 3 one in turn. First of all, market timers, watch out. JP Morgan did a study fairly recently that estimates the annual return from the American stock market, that's the S&P 500, at 9.2%. That's annually over quite a long period, 1993 to 2013. Sounds nice, but here's the really sort of chilling fact, if you like. If you'd managed to miss out on the 10 best investing days, that's the days the market kicked up the most, your annual return drops pretty spectacularly to 5.49%. If you manage to miss the best 20 days from that period, it drops to 3, that's your average annual return. And as you manage to miss the best 50 days, you're down to a negative annual return. And that basically tells you one thing. Trying to time the market, a bad idea. And panic sellers, people who get out of the market at the first sign of trouble, are putting themselves at risk of missing these best investing days because they're not going to get back in at the right time other than by luck. And if you leave it too late to get back in, you miss the points where the market really kicks up. So number 1, be careful. Market timing can be dangerous. You need to be in the market when it offers the best returns, and sometimes those are over quite short periods. Okay, number 2, market chasers beware. Every day you are bombarded by the mainstream media, magazines and so on with tips, ideas, the latest stocks and so on. Just be careful, all right? It's better not to listen to that noise too carefully. Do not be distracted from your core investment strategy. In other words, don't just get pulled around by the latest fad, the latest tip, because chances are once something's out there, once something's public, once you've heard about it through the mainstream channels, it's already been priced up. All right, you may not be getting a bargain. So stick to your investment strategy. Review your holdings periodically and systematically. That's a good way to avoid just chasing the latest idea. Be structured about how often you sit down, review what's in your portfolio and decide whether the allocation still suits you. And try to make sure that you are changing your positions, buying stocks, topping up a position, deducting from a position, reducing a position based on the fundamentals rather than what you just read. All right. So is the decision you're making sensible in the context of asset allocation, diversification, and maintaining the right kind of risk profile, rather than is it something that you've been sort of pushed into doing through a kind of scary headline, let's say. Number 3, passive investors, be careful. Passive investing has its place. I don't want you to think that I'm against the sort of tracking approach in the right circumstances you get from, say, an exchange-traded fund. So it's simple to understand. Someone says you're going to track the FTSE 100. What could be simpler than that, the main market in the UK? As a result, it's a very simple mechanism, a tracking fund. It's often a little bit cheaper than you'd pay for an equivalent fund that's a bit more active, let's say. And you can get quite a wide range of exposures these days to sectors, indices and so on. There are even sort of clever so-called passive funds, which frankly aren't as cheap as you might think they should be, that try and follow investment strategies, but still not paying an active fund manager. Now they have their place in a portfolio, I'm not saying they don't, but some people think they are the solution to every problem in investing, and they're certainly not. First of all, be aware there's no such thing really as passive investing. The moment you allocate your cash to anything, and even if that's just leaving it in cash or putting it in a tracker, you are taking a decision and you will pay an opportunity cost. For example, buy the FTSE 100, and if you literally have to buy the whole FTSE 100 in a tracking fund, you're getting all of it, the good bits and the bad bits. You're not getting any screening out of the bad stuff. All right, and just be aware that your money could be elsewhere. Your money can always be elsewhere. So it's always a case of saying, yes, passive funds are cheap, but am I getting the best return on my capital? Is my capital being allocated the way I want it to be? Secondly, watch out for tracking error. Just highlight that and remind you about that in a moment. And thirdly, understand that anything that tracks the market on a market-weighted basis does run the risk of doing exactly what we're trying to avoid here, buying high and selling low. And I'll just try and illustrate that at the end. So, tracking error, first of all, that's just the risk that you buy into a fund thinking you're tracking something like the FTSE 100. Actually, you're not. You're tracking the bits of it that the tracking fund has chosen to go for. Quite often, those bits will tend to be the biggest stocks in the market, the most expensive ones, and there you are, buying high, potentially selling lower than you otherwise could. And you get a bit of performance divergence when you look at the underlying index and look at the performance of the passive fund you've bought. Naturally, you get a discrepancy. And that's just something to watch out for in terms of benchmarking how you're getting on inside a passive fund. What's your weighting? Now, my point here is just this. Many passive funds will tend to follow the market. In other words, they will buy the biggest stocks in the market by market capitalization, by size. The whole FTSE 100 index is built on that basis. The biggest companies rise to the top. That means they have the biggest market capitalizations, the highest share prices, and so on. Just be a little bit careful. Very simple example, really stripped it down here. Let's say you had 100,000 to invest. That'd be a nice position to be in, all right? And you're going to market weight just between two stocks. Very simple example. Let's say stock A is 70% of the market, stock B is 30% of the market, defined as this tiny little index you're looking at. So what you do is you put 70,000 into stock A, that'd be 100, and 30,000 into stock B. That is a market-weighted approach. If you like, stock A is the big one, so put more money into that one. Alternatively, you could take 100,000 in total, if you were lucky enough to have that amount of money to invest, and just split it 50-50. That would be an even weighting. That would be a kind of portfolio approach. And the reason for doing that is this. All right, there are several reasons for doing that, but one of them is that if stock A halves in value, you lose £35,000, half of that 70,000. All right, with a market-weighted approach. Now, admittedly, if stock A halves in value, you're going to lose 25,000, which is pretty bad in the second scenario too, but it's not as bad. Okay, and the point about losses is they're quite hard to recover. If you were to lose 50% in one particularly large position, you then need the maths of it, say you need 100% subsequent gain to get back to where you started. That's just the maths of losses. All right. So, the final slide is this, on the theme of how do we avoid buying high and selling low. Interesting to just observe what's happened to two indices over quite a long period of time. The FTSE 100, which I keep mentioning, and the FTSE 250, which is the kind of mid-cap stocks. Here go the lines. Now I cut this off a little while ago, but not too far ago. That's the FTSE 100, and that is the mid 250. Now there are many people researching and trying to work out why that is. Why over quite a decent stretch of time, going right back to here, you've had this kind of divergence, if you like, in performance. The £100 invested in the mid 250 back here be worth considerably more than £100 in the FTSE 100, if you want to see it that way. And there's one answer. There are several answers, but one of them is this. Popular stocks tend to get, by definition, the bigger stocks tend to get promoted into the FTSE 100. And if you track the FTSE 100, you by definition then own them. And the less popular ones, the cheaper ones, tend to get booted down into the mid 250. So if you think about it, almost by definition, if you're looking at the 350 in total, the FTSE 100 is kind of gobbling up the more expensive stocks and kicking out the cheaper ones. And a contrarian would say that's not what you want to be doing. You want to be doing the exact opposite. So just food for thought there about being too slavish in terms of which index you follow. So there you have it. 3 ways I'm suggesting, just 3, to avoid buying high and selling low.